Hello, everybody, and welcome to the Frontier View webinar on the global outlook for 2021. Thank you for joining us today for this conversation. I'm sure it will be quite interesting, and we'll certainly have a bit of a back and forth with the Q&A towards the end of the discussion. I encourage everybody to log in to GoToWebinar to make sure that you can see some of the materials, charts, and data that we'll be showing today. And as a reminder, you are welcome to submit questions by clicking on the Q&A box of the GoToWebinar application on the right-hand side of your screen, and just type them to Docker Frontier Webinars. We'll keep a close eye on the Q&A section. If you would like to leave a comment or a question, let us know, and we will try to answer as many of them as we can at the end of the conversation. As a matter of introduction, my name is Martina Bozajieva, and I'm Global Head of Research at Frontier View. And before we get started, I realize that some of you may be new to our company, so I would like to take a minute to provide you with a very quick overview of our firm, how we work with executives at major multinationals, and what are our areas of specialization. If we go into the next page, just a quick overview. Frontier View provides the world's best market intelligence and advisory services for global business professionals. We help our clients grow and win in their most important markets by informing and empowering the market monitoring, planning, execution, and the other critical decision processes for our clients. And we do work with quite a lot of multinationals. You will see on the next page as well. We provide continuous research and insight, custom solutions, and transaction support services. A small sample of those customers you can see here on the page in front of you, and we provide them with timely, actionable insights to adapt and win in changing markets. If you are not a client and you're interested in receiving a 60-day complimentary access to our Frontier View program, please leave a comment in the chat box or email us at info@dockerfrontier.com. And finally, as part of our offering, we're excited to announce that we have recently launched a new mobile application, Frontier View Mobile, which is available on both iOS and Android. And it includes all the relevant content you need to monitor markets, including this webinar recording and the presentation deck, as well as a lot of our news, commentary, and analysis of events as they happen. We encourage you to download the app to have access to these insights, and more than that, at your fingertips. Current clients can access the mobile app using the same login information as our browser application. If you're not a client, you can still download the app and start monitoring up to 5 complementary countries and access other features like daily news and notifications. So with this, I think we're ready to get started for a conversation. A lot of questions weigh on the global outlook for 2021, so I'm sure we'll have an interesting discussion. In terms of the agenda, we are going to start by looking at the outlook globally for 2021. We'll do some highlights across key regions and markets. And of course, we'll talk about implications for multinationals as they're facing what is probably the most challenging planning season, at least over the past decade. Joining me as an expert in our conversation and to bring all this analysis together for us is Ryan Connolly, who is our practice leader for global economics and scenarios. If there are any insights that you see today as part of this discussion or any questions that we don't get to answer, our client services team will follow up with you directly. And again, if you would like to ask us a question or make a comment throughout, please message Docker Frontier Webinars in the GoToMeeting webinar chat box. So with this, I'm going to pass it over to Ryan to introduce us to probably how we want to think about COVID, because this is a question that really weighs on the global economy. And seems to be shaping all of the assumptions that we're making as we go into 2021 planning.
Great. Thank you so much, Martina. And thank you, everybody, for joining us this morning as we discuss what is, as Martina noted, one of the most difficult planning seasons in memory. As we walk through this presentation, the thing to keep in mind is that in most years during the normal sort of annual planning process, what we're trying to do is develop a combination of insights, right? We're trying to draw in the right point forecasts. We're trying to draw in the right historicals. We're trying to draw in the right estimates for future demand to really set strong targets for production, for our sales quotas for the coming year. Those tend to be annual targets, which are haggled between country teams, regional managers, and then obviously all the way up to the sort of corporate headquarters. And that gives you sort of the footprint for understanding how to allocate resources for the next year. COVID is fundamentally disrupting that normal process. Many clients that we've spoken with have even stopped doing full annual plans. They've even resorted to quarterly planning on a rolling basis. Some of them even suspended at some points targets at all, just as business lines have tried to cope with an ever-changing and ever-shifting economic environment for product. 2021 will not be any different. And so because that ongoing volatility is going to remain due to COVID-based disruptions, the shape of this global outlook and what we're advising all of our clients to do is to really focus on internal alignment on targeting the right resilient customer bases for products, identifying the more likely sources of weakness in product portfolios, either for this year or as we go into the back half of 2021. And this presentation is shaped around trying to help inform those internal conversations that should be happening and have already started in many cases. Our assumptions around COVID have been pretty consistent now since about late April, early May, in terms of what the shape of viral outbreaks will look like across the world economy. This graphic here I'll walk through represents that insight, and this has gradually become consensus in the last few months. We had the big first wave of COVID-19 hit most economies, either in the first quarter of 2020 or in the second quarter of 2020. During that first wave, we had massive rises in daily case counts that were dramatically undercounted due to lack of testing. We had the initial implementation of monitoring systems, but they were still in their infancy stage in many cases. And we had sort of dramatic increases in hospitalization in many countries in the world, which put other types of procedures like elective surgeries on hold. After the initial first wave of COVID starts to sort of decline, again, in most economies, this was around May and June of 2020, what you see is governments trying to adjust their policies. They tried to end lockdowns. They tried to relax some of the social distancing restrictions to limit the damage that was being done to the local economy. But as soon as those start to be relaxed, what you start to see is these secondary waves pop up. These secondary waves are significant. In many cases, what they lead to is a retightening of social distancing restrictions as local officials try to establish what was the source of the secondary outbreaks, what are the right control mechanisms to make sure that we flatten the curve again. And then once that's done, expect more phased reopenings to occur. The point here is there's no reason to think that the second wave is the last wave. Especially as we go into the winter months, as consumer behavior shifts, as people spend more time in the household. We're not exactly sure how the viral element will evolve in every country, but we have pretty high certainty that many countries will see third waves or even fourth waves before we get to vaccination. In our mind, COVID is what you would call the dance, is a quote that we used from Thomas Pueyo. This dance will continue up until the point of widespread vaccination via herd immunity, and we don't expect widespread vaccination to start to occur in developed markets until mid-2021. So by the end of 2021, we expect there to be sort of less or even no more social distancing impacts in most developed markets and in some key emerging markets. And so for your emerging market portfolio, part of this is not just understanding when vaccination is actually available, when clients have passed phase 3 trials, but also where you are on the list of actually getting access to enough vaccines to impact the local economy, and then to add the organizational capacity to spread it through that economy.
Ryan, if I can just jump in real quick. The second wave question gets raised in every single client discussion that we have. And my reading of what people usually have in mind behind this is, will we see a repeat of Q2 and the total shutdown? And also because that was also the weakest point in terms of the global economic performance as well. So people are really concerned about a repeat of that. But what they are actually monitoring is case increases, which can increase due to both more actual individuals catching COVID-19, as well as better testing. There's a whole host of reasons that could cause it. What looks like a second wave, if you're counting the case numbers, but that doesn't have the same effect from a business operational perspective as what people really are thinking about when they say second wave. So help us think through this question, because we may be seeing multiple rounds of COVID outbreaks, but how likely do you think it is that we'll be seeing these types of nationwide total lockdowns that people are really concerned about?
That's a really good question, and I think it's important as well, because when people start to do some of their strategic planning and especially scenario analysis, what they are trying to, in some cases, they're doing a sort of worst case hell scenario, where you would see widespread national lockdowns. We actually don't expect that. We do not expect at this point to be any widely spread national lockdowns for a couple of reasons. And the first one is, as you say, although we're seeing daily case counts in some cases match up to the case counts recorded during the first wave of COVID outbreaks, that's mainly a feature of lack of testing in many economies. And so there's various ways you can construct your internal dashboards for market monitoring to get a sort of adjusted rate based on hospitalization rates to understand the actual number of implied cases and match that up to the first wave. You're right, it's much lower, these secondary waves, in terms of number of cases. The reason that governments are responding in many cases rather aggressively with reinstalling social distancing protocols or delaying phased reopenings is because they want to prevent those case counts from getting anywhere near the levels where it would really have a dramatic impact that would lead to a national shutdown. In other cases, contract tracing, especially in parts of East Asia and most of Western Europe, and parts of the US and some other emerging markets, contract tracing allows you to isolate secondary outbreaks into distinct states and city clusters. And so as a result of the sort of combination of better testing, better contract tracing technology, and more social awareness by the governments about how to contain these outbreaks, we do not expect those national lockdowns to come back in the way that we saw them in March and April. So we're talking about a much lower level of ongoing disruption. But that means that what we're really saying is two things. Don't really fear that national second wave lockdown, but also don't expect everything to simply return to normal anytime before we have this widespread vaccination.
Got it. Thanks, Ryan. I think that's clear and helpful, certainly at the aggregate level, but it still causes quite a lot of uncertainty in terms of the macroeconomic outlook, right?
And I think that's the real concern. And so most of this conversation will be sort of developed not around talking about case counts and hospitalization rates, which that information is critically important for market monitoring, but trying to understand how to cope with this uncertainty as you're constructing your plans and approaching markets across 2021. So the uncertainty range here is very strange. I think a lot of us have heard of what's called the cone of uncertainty, which is the sort of notion that when you're setting your business targets, you tend to have much more certainty around the first quarter and the second quarter, so if your next 2 quarters, than you do about sales growth 2 years or 3 years in the future. Just there's so many things that compound to create that uncertainty. COVID has kind of flipped the script here, in that in the short term, due to we don't really know how, we're learning more about the virus every day. Governments are learning more how to manage it. Households are learning more how to implement their own protocols, such as mask usage and sanitation. As we learn more about the virus and get it more under control, develop better treatments, develop better understandings of how much hospital beds we have to keep available, there's a lot more uncertainty. But as we develop that knowledge, that uncertainty range actually closes down. And so the uncertainty that we're feeling right now is actually going to shrink as we get towards vaccination. Once we hit vaccination, we actually have a pretty good idea in most countries about what we think our baseline GDP will be relative to sort of the upsides and downsides. So once that COVID uncertainty is gone, once we have the vaccination and it's deployed in the country, we can actually shrink that cone of uncertainty back down again. Then we return to our normal cone of uncertainty on the back end, sort of after late 2021, mid 2022, where we can start to talk about long-term market prioritization, the risks around different types of structural developments within each economy. And so I think this is what people are struggling with inherently, is that we're used to long-term uncertainty when we make strategic plans. We're not so used to the sheer amount of short-term uncertainty that we're grappling with. And you're not alone. Every single client we talk to is struggling to find the right set of tools to structure internal conversations as they approach resourcing for the end of this year and into next year.
Got it. And as we speak about resourcing and also certainty, this uncertainty is different in different regions, or at least the sense of where we are in terms of the cycle is a little bit different. So next, we would like to ask everybody attending to answer a quick live question for us. The answers will be anonymized and we'll be able to see the results right away. So you'll be able to see what your peers are saying as well. And what we wanted to understand before we look into the geographic distribution of what next year looks like is where do you see the biggest upside revenue growth potential for 2021? Acknowledging that there are differences within segments and product categories as well, but from a geographic perspective, which region do you feel most optimistic about in 2021 specifically, given the dynamics that Ryan and I were just talking about? We'll give everybody a moment or so to quickly answer the question, and then we will share the results before moving on into our comparative analysis on the macro side across different regions. I think Ryan and I have a hypothesis based on client conversations, but it would be interesting to see the results from the overall group.
Yeah, I have a strong hypothesis, and I hope we get the answer I'm expecting.
Yeah, there we go. Asia,
Yep.
Asia. And really, Ryan, we're talking China here, right? At least based on the client conversations that we've been having.
Yeah. So we'll go into the macro numbers in a second here, but definitely the China stimulus is, although our China team repeatedly makes clear that it's of a different character than earlier stimulus, like in 2009, 2010, China's stimulus has definitely supported growth in other markets in the region, specifically domestic China. Vietnam has held in extremely well due to where they sit in supply chains that hit both, U.S. consumers as well as Chinese consumers. So in terms of raw revenue growth, I think that is accurate. I think the question that we're going to ask as we go forward a bit and should be in clients' minds is, does that mean the most margin growth? And I actually think that answer is quite different, where North America will probably outperform margin growth than APAC. And that's just due to price sensitivity within the consumer populace. All right, back in control. Thank you for that polling question. So as we're sort of talking about here, we do expect every region in the world to rebound strongly in 2021. And I'm going to show this on the next page in a heat map in terms of country profiles. The thing to note here is that we've had a historically crippling recession, nothing like we've seen in the world economy since World War II. The financial crisis even was very different because it was weaker in magnitude than this crisis. It was also spread over 2 years effectively. And so you had early leaders in 2010 and 11 helping pull the rest of the world out of recessions as they encountered them. This was sort of a synchronous recession in 2 quarters of the year. The thing to note here most critically is really 2 things. One is that in all those regions where you see growth decline, almost every single region sees growth rebound next year by a lower rate. Just based on how percentages work, even if it's the same exact rebound, that means demand at the end of the year is weaker. This is actually a weaker rebound. And so there's a couple factors that are explaining the sort of weakness of the rebound in that sense that we see next year. One is ongoing COVID disruptions, ongoing social distancing, uncertainty that leads to weaker investment, overcapacity, especially in terms of oil, which will keep export prices for commodities depressed, as well as overcapacity in terms of consumer household durables, driven by a few factors. One is pre-purchasing by households. One is weak labor growth in most regions. And then another factor is sort of the slowdown of fiscal support, as a lot of countries, especially in emerging markets, start to pull back fiscal support or implement tax increases in order to reduce the increased size of deficit. And that's going to be driven by concerns about large deficits and a risk of FX depreciation. And so, although things look much better next year, and they will be much better, this lingering weakness is really what we're focused on in terms of the broad global portfolio. And so what we're encouraging clients to do is think very, very carefully about prioritizing resilient segments of the portfolio as we go into 2021 planning conversations. Yeah, go ahead, Martina.
Ryan, just a quick question that might be on the mind of some of the listeners. What oil price are you assuming behind these numbers?
Yeah, good question. So we are assuming a WTI and Brent oil price of between $50 to $53 for the average for 2021. That is relatively weak compared to historical levels. And the main reason for that is we have ongoing overcapacity issues. We all know that mobility has been weak. We don't expect a full return to international travel, especially jet fuel demand, anytime in 2021. A gradual recovery, but you're talking about 20 to 30% weaker demand at the end of the year in terms of international travel. We still have stay-at-home policies in many regions. We still have a lot of households are reticent to travel by car. So while automobile demand might return in some forms, we still expect some weakness versus pre-COVID levels. And then we have an issue of OPEC, which has decided off and on whether or not it wants to increase or decrease capacity, which has simply contributed to inventory builds that are at historic levels. By the end of 2021, we do expect some of the US energy production to come offline. We expect some lack of investment to reduce some of the energy supply. And then we do expect demand to start to gradually recover post-vaccination. This creates an upside oil price risk for 2022, but in the short term in 2021, we do expect pretty depressed prices still. And as we'll see on the heat map in the next page, you'll see how this sort of impacts growth, and then we'll see how this impacts volatility in sort of our GDP scenarios in future pages.
Great, thank you very much, Ryan. Yeah, so walk us through this one, because I think the point you're making about the local and specific drivers is something that is definitely worth lingering on.
Yeah. So unlike most years where you have pretty strong regional trends in most cases in terms of, growth versus sort of outperformance versus underperformance, we don't really have the map being painted that way in 2021. In a lot of years, like post-recession, you'll have a dramatic pickup in developed markets, let's say, followed a year later by a dramatic pickup in emerging market portfolios. Here you can see it's much more of a pattern to quilt. The obvious source of outperformance is going to be East Asia. That's for a few reasons. One is that obviously China stimulus has supported the market. Two is just it's been a historically higher growth region. And so it's always going to appear a little bit brighter on most of your real GDP growth maps. Again, this is masking some internal weakness because a lot of that growth, because what's happened in East Asia is that you've basically lost a year of growth. And so because you lost a year of growth, any corporate planning that was designed around sort of 1 year or 2 year forward demand portfolios has lost a year. And so it's going to take another year for that demand to actually pick up to the capacity that was built up for that market. And that means weaker employment trends than previously expected, weaker wage growth than previously expected. And we're hearing a lot of internals from China about how weak that labor market has been this year, despite the fiscal sort of supply side push by the government. Looking across the map towards the west, we really see weak growth in Western Europe. And that's for a few factors. One is that the growth declines in Western Europe in some cases have not been as bad as previously feared, especially core Northern Europe. And that's because they have strong employment stabilization. But part of the issue, though, is that the sort of Western Europe growth engine of sort of German-led manufacturing investment that then leads to growth within Western Europe and then also export of capital goods and automobiles, that will still be weak in 2021 and 2022. Consumer households across the world that sort of purchase those products will be weaker, and firms that buy sort of specialty manufactured machine goods out of Germany, again, because of overcapacity, you'll see less export demand for that kind of product. Going a little bit further, sort of if you look sort of south and southeast of Western Europe, you're looking at Central and Eastern Europe, which does pretty well just due to its place in supply chains. But then you hit the Middle East and North Africa, and weak tourism and weak oil prices are going to impact that region substantially. If you look across the sort of continent, US, Canada does actually pretty well in 2021. Mexico only appears to do well because of the crippling recession it's having this year, so it rebounds a bit better. The US recovery is really based around the fact that US households are weakened by this crisis, but we do expect gradual recovery to continue. US households have high savings rates, and you have a lot of resilient pockets of demand in the US in terms of white collar service jobs. And so that's actually a very resilient customer base, who actually have excess savings and are attractive for premiumization strategies. And then Latin America is really, really a mixed picture. Producers of commodity exports like copper have done comparatively well due to inbound Chinese demand, as well as mine disruptions in 2020 that have raised the price of copper. Brazil sees sort of languishing weakness. It's had a few sort of rough years in Brazil, and now we're back in kind of a depressed environment. So as I said, looking across the map, it's very hard to prioritize regions in the way that we might be used to in previous planning years, and we really have to look at it at the country level to make sense of the map.
So at the country level, one of the big questions that we get from clients as they're trying to benchmark themselves is, when do we get back to 2019? And one simple way of looking at that is by looking at the size of the economy overall. Could you give us some examples of when do countries land back into that magical 2019 level?
Yeah, definitely. So time to recovery is one of the most important metrics to track right now. It doesn't tell you everything about the country, but all we're looking at here is, given your aggregate GDP in 2019 pre-COVID, that's again sort of aggregate supply and demand. Based upon the size of the contraction in 2020 and then the growth rate in 2021 forward, when do you get back to those pre-COVID levels? Most of the world recovers right around 2022. That's kind of the sweet spot. Recovery in oil prices, recovery in some international tourism because of early vaccination in some of those countries, as well as countries that are sort of reliant upon in the early phases of capital goods and consumer durable supply chains. A lot of that happens in 2022. So around that date, you've got leaders and laggards. Leaders are obviously China. 2020, it actually is able to hit pre-COVID levels with weak growth of around 2%, but still positive growth. It doesn't feel that way on the ground, and that's very important to reiterate, is that there was a lot of internal weakness in China. There's a lot of consumer weakness, but overall GDP growth rates, they will slightly grow in 2020. Vietnam, again, performs well. 2021, India, that is just based upon previous strong growth rates. But then you look at the laggards, right? You have a lot of your economies in Latin America that fall in that bucket. You've got a lot of commodity exporters like Canada and Peru that also fall into that bucket, and Chile as well. And then obviously you've got the 2024 plus, which are economies who, due to a combination of pre-COVID weakness, as well as particular features about their sort of export and domestic demand portfolios, are going to take several years, right? 2024 plus to ever really recover. A lot of those guys are already sort of highlighted as slow growth drivers before the COVID crisis. This has just exacerbated those negative trends.
And if you look at the aggregate level, Ryan, when do you think the global economy will get back to where it was in terms of size in 2019?
So on an aggregate level, we actually expect that to hit sort of early 2021. But again, a lot of that is being driven by growth in APAC. In terms of, if you strip China out of the equation, you're talking about 2022. And that's really because the US is such a large economy that it helps, along with some of the other emerging economies, to lift it out.
Got it. Thank you.
The important thing to think about here too is this is a chart of the employment effect. And I actually took this from a very smart economist on Twitter. The initial lockdowns from COVID are fading, and that create a lot of upside optimism in markets. And that's the green line here. But COVID is a disruption which has left scars across the economy. And those scars are in the form of, again, ongoing COVID disruptions are still happening. And that leads to job destruction. So we're seeing restaurants and bars close down across the world. We're going to see tourist and hospitality sectors of the economy basically have 2 years of lost income, especially in a lot of your emerging markets that have beach tourism. And that will leave, again, very deep wounds on sort of low income and even up to middle income households that own those businesses. And then that sort of trickles up into suppliers of retail storefronts, so people who manufacture the equipment that goes into food and restaurant. Those are high income channels for a lot of even consumer staples products. And so these scars are being felt, and every day you're seeing large multinationals report large restructurings in which two things: one is just large job cuts, or two is temporary unemployment that are now becoming permanent. we haven't even really started to feel that yet, but the ongoing increase in permanent unemployment is happening across markets. Um, and that's really what we're doing is COVID is going to fade into what feels like a normal deep cyclical recession. And so preparing in advance for that is really why we're saying focus on your resilient households, because during the worst of the lockdown waves at the peak of the green line, you also had the best fiscal support and you had households using limited savings to bridge that gap. You had aggressive central bank support, aggressive liquidity support also come in there. But as COVID's disruptions start to fade, that fiscal support and that household savings is being depleted. And that's going to lead to the much more painful period of permanently higher unemployment that will take years to recover. You'll also see distributors, key end clients, some of them will limit their purchases, close locations, and simply just shift their business strategy. And so that's what we're seeing sort of ongoing, and what's creating our sense of a longer recovery time than many people are talking about.
Hey, Ryan, I was wondering if you could talk a little bit about the difference in the level of permanent unemployment created between the US and Western Europe, given slightly different approaches to job protection. Do you expect to see, I guess, a little bit less of that permanent unemployment creation in Western Europe based on how those markets are approaching this? How would you see it?
So it's so the US, you're right. So the way that the US economy works due to relatively weak labor protections is unemployment, permanent unemployment rises pretty quickly. Firms are free to sort of fire workers at will in most cases. And then that means that firms are able to recover faster in terms of bottom line sort of profits, and then move back into an expansion phase, and then increase employment quicker. In Western Europe, you don't see the immediate impact in higher permanent unemployment or even temporary unemployment due to stronger labor market protections. The problem that Western Europe is grappling with right now is that even before COVID, you saw signs of emerging weakness, especially in Germany, in which sort of demand for worker hours was shrinking. Germany offsets that with a program called Kurzarbeit, which means that the government actually pays companies to keep their employees. They basically subsidize them for the hours they don't need. These sorts of sort of welfare support programs can only go on for so long before the budget deficits rise to a point where Western European governments will clamp down and start to have to sort of unwind some of their sort of beneficial support programs for their employees. Also, although Western European markets are a little bit stickier, it's not like companies can never fire workers. There's usually just longer time frames. So I actually do think that because 2019 was already weak, 2020 is obviously very weak, 2020 won't see much improvement. I think you'll gradually see a higher trickle up in permanent unemployment or weaker wage formation in Western European governments for your kind of 2023 plus targeting. That's partly why the recovery in Western Europe is lagging as opposed to the US, which recovers much quicker.
Yeah, thank you for making that comparison, Ryan. And before we move on, just a reminder to those listeners on the line that if you have thoughts or questions you'd like to share with us, please use the chat box to share them. We will do a Q&A at the end of this conversation. So looking forward to your questions as well. But Ryan, I wanted to go back to something that you alluded to, which it would be great for us to dig into a little bit deeper, which is the segmentation question. So you're seeing outperformance in certain groups of customers in certain industries. Does that create upside opportunities for companies despite the somewhat gloomy overall macro environment?
Yeah, it does. So it definitely creates an ability to outperform your competitors if you target the resilient segments and deprioritize segments of the consumer economy that might go away or see weaker demand or see more price sensitivity in 2021 plus. This is something we were already talking about in 2019 as we saw the economic cycle maturing, and obviously COVID has exacerbated that. So I think we'll move into the segmentation stuff now. Generally across the global economy, what we're seeing is what we call a swoosh-shaped economy. So a lot of press commentary keeps discussing a V-shaped recovery, in which case you'd see a rebound all the way up to pre-COVID levels of GDP very rapidly. What we're seeing is a second quarter bottom in the global economy, a very rapid recovery in the third quarter off the lows as lockdowns end, but then it becomes sort of a slower and slower trajectory of positive growth as we sort of go forward in time until a full recovery. Again, this is illustrative, but that's sort of what we're seeing across most markets in the world, is a slowing rate of recovery. And we expect that to continue up until vaccination in the second quarter and third quarter for most economies. But that is going to lag out due to what we just talked about, the rise in structurally higher unemployment and the destruction of businesses that will take a while to recover. But in terms of segmentation, more than most recessions, there's very clear winners and losers in many countries emerging from COVID. Your COVID winners basically do see some weakness in the second quarter in most cases, but very rapidly actually rebound, and actually their sort of demand revenue growth actually exceeds pre-COVID levels, even by the end of 2020 and going forward. We'll talk about a few of those going forward, but the clear example would be cleaning products, right? Massive surge in demand, massive supply chain issues in order to actually just get enough product out to market, clear opportunity for disruptors to enter the marketplace, premiumization for higher quality brands. That's the clear winner from a COVID type situation, telecom equipment, etc. Losers are your lower income households, your hospitality sectors. Again, very easy to identify, but we think using this conceptual framework at the local level is actually a very effective way to structure conversations in order to try to make sure you're hitting the right targets in 2021. I'm going to show this on the next page in a more illustrative way, which is what's called the sort of K-shaped recovery. Again, we're using this to identify winners and losers. So these discussions should be a way to segment your customers, priority industries, priority consumers. So there will be overlap in these categories, but when you think about the winners, strong domestic policy support from the country level has been a clear winner. Your industry is obviously at-home consumer goods and technology and software. Demand trends for that will shift a bit over time as we had pre-purchasing by consumers. That will probably slow, especially for electronics, but we actually still see that to be a winning sort of portfolio going forward. Consumers, obviously the white collar services workers are the least impacted, as well as your higher net worth households due to rise in equity valuations and sort of financial assets, which allows for ongoing consumption off that. And then capital access. So capital markets have been pretty active. Larger companies can issue debt, issue equity pretty freely, and a lot of central banks have created a set of programs to support those asset prices. You compare that to the losers, weak domestic policy support countries, countries relying on tourism, commodity exports have generally lost out. Obviously, your cyclical industries have lost out, energy, capital goods, but also these travel companies, that's usually pretty cyclical, but also at-home consumer brands or even consumer staples that rely upon sort of high profit channels that have been disrupted. So, food and beverages that have a high degree of sales and high margins at stadiums would be one clear example. For your consumers, blue collar services workers, manufacturing workers, just given the slowdown, low net worth households, obviously the most disrupted by COVID, are seeing the weakest performance going forward. And then capital access, consumers and small sort of firms that have to rely on bank loans. We've seen a lot of tightening as banks are getting worried about the credit capacity and the ability for households and small firms to meet repayments. And so that last point about smaller companies that rely upon bank access is why we've repeatedly harped and discussed with clients strategies to support your sort of essential distributors and some of your essential end customers during these trying times. So really using this sort of analogy for us is a good way to structure conversations. And just in the next few pages, I have a few sort of global indicators of how to segment that. But this really has to be done at sort of the country and even city level in some cases to really understand how this network of government support, local restrictions, customer profiles sort of intersects in the sort of short and medium term for looking at your 2021 plans. This is an example from the US just by employment. And so we're trying to identify resilient consumers. US has really widely available data. No surprises here. We're just looking at employment in terms of how disrupted was employment. in these key industries, and then how has the recovery been? So total non-farm, that's basically your overall employment for the economy. You've largely recovered from the COVID crisis. You're still about 7% below pre-COVID levels. We do expect lingering unemployment to remain, but that's a pretty substantial recovery off the lows, and we do see that creeping up as we go forward in our swoosh. Retail trade has actually shown a much better recovery, only being about 3% below pre-COVID levels. Some industries, of course, are doing even better, but look at leisure and hospitality. That's about 10 to 15% of the US workforce has languished substantially, rebounding sharply off the 50% lows. But you're still at about 25% of US workers in that industry who don't have jobs, the ones that do have weaker wage formation. It's questionable whether that goes up or down going forward. And so we see some similarities with this K-shaped recovery in terms of employment and wage formation across most countries in the world. In terms of industry, again, we're providing the deck, so I wanted to leave in this even though the text is small. There's some clear winners from the stock market's perspective. So here I'm looking at multiple expansion for some key industries. I'm locking earnings to strip out the cyclicality, but you can see where people see the best medium-term performance occurring in terms of revenue growth. The right side is obviously the strongest multiple expansion. Internet catalog retail, technology hardware, et cetera, top the list. So we're seeing a lot of demand here and a lot of expected revenue growth for at-home consumer products, software and computer technology products, and then transport and logistics as firms try to adjust their go-to-market strategy. On the weak side of the equation, energy, banking and finance, and capital goods, there should not be surprises in any cyclical recession to see weakness. The interesting weakness here is we also see weakness in consumer goods and services. Service-based weakness is not a big surprise, but again, in many consumer goods, we see beverages pop up. It's because tobacco and industry. It's because one, their high income sort of revenue channels are being disrupted. So drinking at bars, drinking at stadium events, drinking at movie theaters. And two is also probably some trading down in lower income households to generic brands, especially in cash-strapped emerging markets. So a lot of this reflects, I think, what we already know, but it's important for customer segmentation, especially as you think about pricing sensitivity.
And
sorry, Martina, go ahead.
If I can just go back a little bit, I think one of the questions that a lot of companies are trying to deal with is how much of these drops in demand, and if we just take this as an example of some of the demand dynamics that we've been seeing, not just in the US, but in other markets as well, how much of this is due to COVID, and therefore either a spike in demand is likely to normalize or a drop in demand is likely to get back to more normal levels, and how much of those are structural changes? And we get these types of questions around, will people ever work in offices again? And if so, how many? Will people ever fly again? And if so, to where? And et cetera, et cetera. So a lot of companies are facing questions about how much of these changes are structural and how much of them are purely in response to the pandemic. And once the pandemic is over, even if it's in 2 years from now, those patterns of behavior are likely to normalize. That has long-term implications for those industries as well. How do you suggest addressing this question? Obviously, lots of industries here, so we can't answer it for every one of them, but what are some of the approaches that you would recommend?
Yeah, so I think so there's the end demand question, and there's the channel question, and I think that what you're seeing reflected here on the winners is a lot of channel. And so obviously COVID has accelerated a shift towards digital and online channels that was already ongoing and already a focus of a lot of our sort of clients. What you've done is you've basically sucked in an entire older generation into some of these digital channels that they weren't using before. And I think once they discover the ease of service, they're going to be sort of sticky. So that's where internet and catalog really stands out as the winner here, as well as some of your tech and software. In terms of workplaces, I think it's too soon to declare the end of the physical workplace, but I think you'll have a shift in preference to provide a high quality digital experience because your customers will expect it. And in many cases, firm leadership will be more willing to adopt sort of remote employees or remote type situations on a case-by-case basis. And so what you'll have then is actually a redundancy in which firms will maintain a physical workspace, maybe a little bit smaller, but also a sort of constant buyer for some of those digital services. So I think that's really the storyline here, is an accelerating shift of some of these pre-COVID trends is just sort of taking hold much more rapidly than anybody expected. In terms of the energy, oil, and gas question, you're basically losing a year or so of demand formation. And so part of what that does is it accelerates some of the shift towards technology, because in a year or two, the technology for EV will be much more mature. And so because the replacement cycles of autos have lengthened due to less usage, when consumers go back to buy a new car a year or two later than previously expected, the technology will be better developed and they might shift more rapidly than we expected to some of those EV and renewable type technologies.
Interesting. And I guess we could also say that some of these dynamics, not on the technology side, but in terms of customer behavior, there's a country level element to them as well, because in some markets, you never had e-commerce at anywhere at the infrastructure level that you need to be able to benefit from a switch. So there may have been an acceleration, but the infrastructure may not be there to support a substantial change from offline to online. In other places, you might also see culturally a much greater reluctance for people to work remotely due to management culture, etc. So there's a country level element to this analysis that also overlays on top of the structural and COVID analysis to it. Is that a fair statement to make?
Yeah, every year country level analysis is required, but this year in particular, even when you're tracing things like propensity to have secondary outbreaks that go unchecked, the digital infrastructure has been necessary for many countries to implement contact tracing programs, which allows more rapid response to COVID. So I think that you'll see, number one, as you say, a real need to look at local factors when you set your priority sort of market regions. But two, an acceleration of some of those governments who've now realized the necessity to catch up to some of their competitor countries in terms of offering digital solutions, simply in order to attract inbound investment, right? Where it becomes the expectation by multinationals that they can apply the same sorts of technology and sort of client targeting in those local economies. I'm gonna rush through a few slides here. These will be available on the website and on the app for those who want it, just to sort of get to the questions. These are just two examples of recovery, the positive and the negative. So the winner is clearly China, where we see a recovery to pre-COVID levels pretty early for most key industries. A lot of the upfront is supply side stimulus infrastructure projects, which our team expects will lead in 2021 to a recovery in consumer households, where unemployment is currently weak, wage growth is currently weak, a lot of weak confidence. So we do expect that recovery to take hold in 2021. Again, it doesn't mean that that price sensitivity evaporates tomorrow, but it does mean a sort of gradual recovery as compared to what we see in Latin America, where we see COVID weakness lingering well into the end of 2021 for most of your key retail, the exception being FMCG, where we do expect a sort of moderate recovery, but obviously a much more red map, with the main winners being IT and telecom. This sort of, as previously discussed, a shift in both structure but also in channel. So country performance is going to vary very significantly here going into 2021. And so these are a few of the things that we think is important when you're doing kind of a sort of 1 or 2 page analysis of country prospects. Pre-existing country economic fundamentals is still weighing very heavily, and based on previous maps, I think it's very clear why we expect performance in most sectors to apply to APAC just due to previous pre-COVID high levels of growth, the US due to the sort of structure of the economy. But we have a lot of other things to focus on this year. So obviously domestic COVID outbreaks, effectiveness of containment measures, how important the sectors that are most disrupted are in that economy. And so obviously tourism economies will suffer more than a white collar services economy. And then of course, effectiveness of policy stimulus, size of it, targeting of that stimulus, the broader external environment in terms of external trade, and then vaccine distribution. So these are all sorts of things that we think are important to check the box on as you implement your plans. In terms of our uncertainty, I communicated up front that there's more uncertainty in 2021 planning than any other time that I remember. And what we're trying to find is the most resilient customer bases. And so one way to approach this, as we talked about, is figure out the households. One way is figure out the industries that are most resilient for those who sell B2B services or sell B2C, but can target a little bit better which employees and which market are going to maintain job access. Again, higher versus lower income households. This map here reflects our sort of range of uncertainty, sort of the variance in our upside and downside scenario cases for each country in terms of growth by the end of 2021. So what we're saying here is there's a lot of propensity for downside scenarios. Our bias is downside in most economies. At the end of 2021, based upon that downside scenario, how much weaker is it than our base case? And similarly in terms of the upside. So what's the variance? Firm targeting is going to be better suited by targeting countries with low variance, right? So the lowest variance is going to be the US, China, India, Indonesia. So APAC and the US has the lowest variance. For the US, well, so the high range here is about 3.5% variance, which means that GDP at the end of 2021 might be 3.5% higher or lower, basically on average from our base case. Looking across the rest of the world, you can see extreme variance in countries like Saudi Arabia, which relies upon oil export recovery, right? So sustained weakness in oil export markets or an upside price shock, high variance in that economy. What that identifies is both a region you might want to deprioritize in terms of your base case targeting, but also a region you want to be prepared to rapidly adjust your plans on if you sell into segments that will dramatically improve or weaken due to ongoing events in that market. And we see similar high variance in Western Europe. Also across Latin America, again, a very mixed picture, right? And so this is where you really need to sort of engage in a structured conversation about the upside and downside drivers, implement your market monitoring to fit that.
Thanks, Ryan. And before we wrap up with planning advice for companies and take a few of the questions from the audience, we wanted to ask the audience one last question through our live polling, which is really about how you're thinking about downside scenarios for 2021. So many of you might have expectations to what you consider demand being back to normal. Normal might mean for you 2019 levels, or you might have a different definition of it. But if you think about what a downside looks like, by how long do you think it might derail your return to normal relative to your current base case scenario? Do you expect that downside scenario might delay your return to normal demand levels by a quarter, by 6 months, maybe by more than that? Or does your downside scenario actually still assume acceleration in demand? We would love your perspective. Again, answers are anonymized and you'll be able to see the results of the survey live in just a couple of moments when we have had a group of individuals who've taken it. And what we're trying to understand here is what kind of disruption to timelines to recovery are companies concerned about, and how significant could that delay to recovery be, depending on what kind of downside scenario you're thinking about. In many cases, the companies we speak to are defining downside scenario as a second wave or some level of later recovery. And I think we'll get a sense of how much later are we actually talking about based on what's being put into corporate plans.
Mm-hmm.
Okay, and it seems like the group clusters around 6 months or so. So that is actually quite significant, followed by 3 to 4 quarters. So anywhere from 6 months to about a year is what some of the downside scenarios out there are planning to see. So Ryan, when we go back to the scenario question, what are some of the things that you think companies should be putting into their plans for this year, given how unusual the situation is?
Yeah, good question. So this is what we've identified as sort of the strategic, like the priorities in terms of evaluating your strategic plans. We've already given a couple of useful tools, K-shaped recovery, how you think about segmentation, but sort of the focus number one is sort of on the left there, improve internal alignment. I think that it's correct to assume that between 6 and 12 months of delay in demand recovery is about what I would expect from most in average and in aggregate for most markets and customer segments. But one of the keys here is just internal alignment is critical to implement a good market monitoring profile, identify the drivers that you're looking for and the signposts. The quicker you identify the signposts in terms of whether or not you're going to hit a downside or an upside, that means that you can rapidly adjust your targeting, your demand production profiles, etc. And so you have to be deeply aligned within your organization in order to achieve that task. So that for us is the priority. The second one is pressure testing your global portfolio. And part of that actually feeds into scenario analysis and contingency planning. I mean, all of these things are actually forms of generating alignment. It doesn't matter if your scenario is correct, right? What matters is that you've had a process where you think through what a downside looks like, what it's going to be most likely driven by, and what your response would be, so you can respond basically in real time with minimal lag. And so all of that together is really our priority. We've seen two sort of special priorities emerge here. These are actually kind of pre-COVID trends that we see continuing. Localization. We put out a big piece on supply chains. We've all seen disruptions to supply chains from the last year, and that's actually accelerated previous trends that are both driven by ongoing trade wars and disruptions on the negative side, but also on the other side by changing customer demands who want faster time to market. They want more customization strategies, and also by governments who are looking to capitalize on local labor to hit their own revenue shortfalls. So localization continues for myriad reasons to be a priority, and COVID has highlighted another reason is supply chain resilience. And then obviously digitalization has been on top of everyone's minds for years, and COVID has also accelerated that. And so in general, these are sort of the main things I would ensure that you have at least a discussion on or a view on in your firm, is that you're aligned across these sort of major objectives.
Great. Thank you very much, Ryan. And I think we're getting quite a lot of questions from the group, so I think we might as well get started on answering them. And one of them is around Asia, and in particular, why we are a little bit more pessimistic about South Korea and Japan, given that we expect a strong recovery in China.
Yeah, with Japan, it's partly just a function of pre-COVID low growth, and partly because you've seen such a massive disruption in terms of consumer behavior in parts of Japan. It's a highly services sector-based economy as well. It just takes longer to recover. And that way, it's kind of similar to what you see in Germany, where it's also a slower recovery in some aspects. Again, heavy sort of capital goods, machine tools exporter. Another thing about Japan is their main source of rapid growth in recent years was actually a massive increase in inbound tourism, especially international tourism. And that's been disrupted fundamentally by this. And so that was one of your key growth drivers for GDP. And then obviously ongoing demographic decline. So Japan is just kind of in a spot of remaining weak. And so also the China-Japan linkage is not as close, except for in terms of inbound tourism, especially for retail shopping. And so Japan won't recover simply because China recovers in terms of its domestic production profile. In terms of South Korea, part of it is simply because of an expectation that a lot of the demand inbound from South Korean imports of sort of computer technology and semiconductor chips has been slowed, because China's focus on the sort of supply side recovery in the short term has been more of a focus on sort of heavy capital equipment and infrastructure build on the one hand. On the other hand, sort of consumer targeted demand import increases. It just doesn't hit the sweet spot for South Korean exports. And so that's a lot of the global story there, besides some of the fiscal decisions being made internally in South Korea.
Got it. Thank you, Ryan. So there is a question here, which is, I think, touching on one of the big trends the team globally for us is monitoring, which is the political disruption that comes from some of these massive events, both health events as well as economic events. So the question is whether we foresee civil unrest in any particular region in the next 2 years. I might throw in my own opinion on this one, and I'd love to hear yours, Ryan, as well. But I would say that already that has started, right? So since COVID started, we've seen different types of protests in a lot of places, anywhere from Lebanon and Iraq to Belarus, to Bulgaria, to Tunisia, Thailand, Chile. The US maybe even adds to this list. And then we're watching a bunch of other countries as well, from Ecuador and Colombia to parts of sub-Saharan Africa, Ethiopia, for example, etc. And that is a short list. And then we also recently had, of course, Nagorno-Karabakh between Azerbaijan and Armenia escalating in a substantial way. Overnight, we had protests taking over the parliament in Kyrgyzstan. This is our new normal. In the next 2 years, I guess we will be seeing changes to governments, large-scale protests, and a whole range of different types of political disruption that comes from it, some of which we'll be able to see coming, and some of which will be as if coming from out of nowhere. And it might be very difficult to know exactly what is going to tip over populations that maybe have been passive for a long time to suddenly start to protest. But of course, that adds another level of uncertainty to our global forecasts. What is your take on this, Ryan? And maybe you can throw in your view on the US election, since we haven't really touched on that yet.
Sure. There's an interesting paper from a professor at Yale who looked at the outbreak of revolutions in France across time and found that the #1 predictor was an increase in the real cost of bread. But what that taps into is a very real sense that the countries most likely to see outbreaks of political protests that are highly disruptive or even violence are going to be countries in which you have high inequality and where low-income households will see a sustained disruption that leads to lower purchasing power. There's a reason the K-shaped recovery analogy is echoing so well right now, which is partly because of a recent focus in Western media about inequality and distributional issues, especially in the US. And so I think what you're seeing is that tap in very, very viscerally right now. So some of the protests in Latin America, like we saw in Chile and we saw in Colombia, to some degree predated COVID and in some ways exacerbated post-COVID. Those are regions in which inequality is relatively high, in which there's been a historic focus on inequality as a sort of social protest movement. But yeah, I think that it's relatively clear to see why there might be further political disruptions due to our view that you have a sustained period for the next year or two in which lower income households, especially in emerging markets that are reliant upon tourism, low income local services work, and mining and other sort of resource exploitative activities, could see further outbreaks. So anything across the EMEA portfolio, I think, is probably pretty fair to look at as a possible risk. Anything in Latin America, for sure. And then obviously East Asia, never really a priority, just simply due to how the structures of government work and due to concerns like in China to make sure that lower income households are being supported during this downturn or that local outbreaks are controlled very rapidly. Just in terms of the US election very quickly, we do expect that Biden will win the US election. We think there's a pretty high chance he takes the Senate as well. That will probably lead to a relatively, in the case of a Senate sweep, obviously some sort of more progressive legislation meant to even further support low-income households and a focus on race relations in the US. Even if Biden simply wins the presidency, which we see as a 70% likelihood, a better renewed focus on sort of race relations and an attempt to diffuse some of the widespread protests we've seen in the last sort of 6 months in the US.
Great. Thank you very much, Ryan. And unfortunately, we're over time, and we know everybody is very busy with planning right now. So if there are any questions that we were not able to answer on the line today, I think there are a few. We will follow up with responses through your client services manager. Everybody will also receive a recording of the presentation within 24 hours. You can view these webinar materials and much more on our new mobile app, which is available for download right now on iOS and Android. For complimentary access to our suite of resources, including data, dashboard tools, and market monitoring reports, please email us at info@dockerfrontier.com, and a member of our team will be in touch. Thank you, everybody on the line, for joining us today. We look forward to speaking with you again soon.